And so as we gather around the campfire of economics to learn more economics once more, I actually wanted to make a short response to the video by Economics Explained on debt. And whilst most of the video is fine, there are 2 points that I wanted to touch upon, a few misconceptions that I wanted to clear up with my video that will help explain the role of debt and the role that banks play in today's economy. So we'll get into it. I'll show the first part of the clip and then I'll show you what I mean. So let's get into it.
The financial crises that we lurch between decade to decade are debt crises. I mean, we just take them for granted today. We are even taught that they are just part of the business cycle.
And so this claim actually is flat out wrong. And so if we take the 2 crises, the 2 big ones of the last decade, of course you have the global financial crisis and then we have COVID. But the thing with the global financial crisis is that it was not a debt crisis. It was actually caused by a global savings glut. It actually took a global effort to get there. Basically what you had a situation whereby global savings needed a safe place to go. And that safe place ended up being the US. The safest security on earth is the US Treasury. But if the US government is not willing to create more US Treasuries, then these savings need to still go somewhere else. And that is where we get the private sector stepping in. And of course, you'll have heard of mortgage-backed securities. These mortgage-backed securities and other securities like them, but these are a big component, they enter the picture and they are created by the private sector. And they are AAA rated by all the ratings agencies and lots of people that collaborate to help give them a AAA rating. And these are the same as US Treasuries. And so the thing is, these global savings then go into these mortgage-backed securities because the world thinks that these are essentially as good as gold, that they are as good as US Treasuries. So this global savings glut remains. You can no longer buy US Treasuries, and this creates an incentive to create more mortgage-backed securities. But you can't just create them on a spreadsheet. These have to represent something. And this creates an incentive for the entire system, for many different classes of people, to push more home loans. But of course, people can only have so many home loans. You generally don't get more than one home loan. And so then we get more marginal loans, like ninja loans. No income, no asset, no job loans. And other similar loans that probably should not have been provided to first homeowners. And the idea is that you provide a place for the global savings to go. And so as evidence for the US being a safe place for people to park their money is that in both crises, in both 2008 and now, the USD goes up in the crisis because it's a safe place. It's the safest place to park your money. And so in a crisis, everyone wants to rush to the US dollar, and so it goes up. And so yes, we have debt in this cycle, but it's not the primary cause of the financial crisis. What actually ended up happening was that it was not in the banking sector. It was in the shadow banking sector that the crisis started. And the shadow banking sector specifically was not as regulated. And so when there was a run on the shadow banking sector, eventually we all ended up paying for it. But it's a mischaracterization to say that it was simply debt going up, that there was too much debt. Yes, that was a part of it, but the forces that helped create that were much bigger. So the main takeaway is that it was not inevitable. It was not something that was going to happen every 10 years or in a very predictable manner. The point was that home prices went down, and when they went down, the value of the mortgage-backed securities went down, and then there was a run on the shadow banking sector. But that's not something that happens every 10 years or every 15 or 20 years or something like that. It took a Herculean effort on the part of many different people. And so it's a mischaracterization to say that, oh, this is something that just happens and that there's nothing no one can do about it. So that's that point, and now we'll get to the last point in the video that I want to talk about.
In a typical home loan, the bank is protected by 2 layers of assets. They have the mortgage contract itself, which is a contract that legally makes the borrower obliged to pay this amount for this long, and if all of that goes downhill, they can repossess and sell the house as an option of last resort. This alternative type of banking does not have that first layer level of security. This gets even more interesting when you consider businesses. Banks like these will not give loans to businesses, but they will instead invest directly into businesses or projects that they think are going to turn a profit. Again, this means that these banks will ultimately be exposed to the decisions that they make, and they need to ensure the fundamentals of the business is sound, rather than just relying on the fact that they can repossess owner's equity if needed.
So this final point is about banks in the Middle East that don't offer traditional loans, and it's very well worth watching the video, but the point here is that normally when you go to a bank and you get a loan, what happens is that the bank will provide a deposit for you, you have that deposit, that's your asset, and then you have to pay back the loan. And the bank essentially keeps an arm's length distance from you. If you default, the bank takes on that risk. But also the bank will collect interest. So the idea is, instead of you having to save up 100% of the money needed to purchase something, the idea is that you can bring that forward, and the price you pay for bringing it forward, bringing your consumption, or in this case the investment forward, is that you have to pay interest. But the thing is, with these banks not offering traditional loans, and where they invest directly with you, as said in the video, well, they don't do that out of the kindness of their own hearts. They're doing that for a reason, and they're essentially going to become an equity holder. They're going to become a shareholder in your business. They're going to be more intimately involved with your business. And this is why this is a very niche offering, and why it's not the dominant banking model around the world. Because you as a business owner, you don't want the bank to get that heavily involved with you. But if this interest and ultimately indebtedness is not involved, the bank makes money by getting much closer to you, and your business activities are going to be much more heavily scrutinized by the bank. You're ultimately going to be more personally responsible to the bank. Whereas right now, if something goes wrong and you need to pay back the bank, there are many different avenues you can go down to pay back the interest and the loan. And that's the point, it gives you way more options. Whereas if something is going wrong with your business and the bank is more heavily involved, it might just be that the bank might just take over and might make decisions for you. That's the thing, that is the price you're paying by not going heavily into debt and by not paying this interest. Ultimately, that's why it's a niche offering. People desire more freedom in general. And of course, with this freedom comes the cost of the interest. And so to sum up this video, we have the global financial crisis in 2007, and we have COVID, which is happening now. Those are not debt crises. Yes, they involve elements of debt, but debt was not the primary determinant or the primary cause. As I was mentioning, in the global financial crisis, we had a global savings glut, and now high indebtedness may exacerbate the crisis, but did not cause it. What caused it was the fact that we voluntarily shut down the economy so that more people don't die from the COVID-19 disease. And when we get to banks and we get to interest and we get loans and indebtedness and all that, ultimately these banks in the Middle East, they are very niche. And the reason for that is that we in general desire more freedom, and ultimately we want to keep ourselves at an arm's length distance from the banks. And the price of that is higher indebtedness and more interest that we have to pay to the banks. And so yeah, I hope I've explained my reasoning and why I think those parts in that video are wrong in an otherwise excellent video. So yeah, thank you for watching. Subscribe, rate and share, all the good stuff. Definitely helps my channel, and I'll see you guys next time.